What's up, everybody? Joseph Vierra here. Thanks for opening the email and clicking on the link to watch the video. I'm hopeful to provide you with some valuable real estate content that I hope you won't ultimately unsubscribe this list from me. And who knows, maybe we'll even meet one day and I'll either list or sell you a home. Now back to the content. Are you underestimating the power of a mortgage? Today, I want to share with you the 3 most valuable factors you need to know. The first point is your mortgage interest deduction. So as part of your mortgage, you have a certain part of the mortgage payment monthly that is for interest. Say if you're one of my clients, you're probably buying a house around $775,000. The mortgage for that is about $600,000 with 20% down. And at today's rate of about 7%, you might be paying about $35,000 per year in interest. And so that cost, $35,000, is going to offset your taxable income. So say this client has an income of $200,000. Well, now their taxable income, instead of $200,000, is now say $170,000 or $165,000. And so if your tax rate is, let's say, 30% in California, a third of that is $10,000. And so you actually saved $10,000 that would have otherwise been paid towards taxes by way of the mortgage interest deduction. The second point is that your mortgage really acts as a forced savings account. So while you're paying interest on one side of your mortgage payment, you're also making a principal payment against the balance of your mortgage. And so really the best way to look at this, or a smart way to look at it, is that you're forcing yourself to save a certain amount of money, because every month, little by little, the mortgage is going down, creating a little bit of equity. But over a long period of time, this is how we build the vast majority of our net worth. For example, in this scenario, you probably pay about $5,000 or $6,000 in principal payments, which therefore lowers your loan amount and gives you that additional equity. Another way to accelerate this savings would be to make additional payments. Some people like the idea of making 13 payments over 12 months, or some people go as far as to make bi-monthly payments, even so that's 24 payments instead of 12 payments. So it really just depends on, obviously cash flow and what you can afford. And so there's some small ways and some large ways to make additional savings for yourself. Point number 3, and really the most powerful part of a mortgage, is the leverage component. It is really one of the only vehicles available where you can put a small percentage of equity down relative to the asset that you're purchasing. And you have control over it physically, and you can leverage it for appreciation over the long term. There's really no other opportunity out there. You can't go and take 20% of Apple's stock and purchase it and then get the benefit of riding Apple for 20 years, for example. And so that's what makes a mortgage and homeownership and real estate one of the most powerful vehicles available to us. Ultimately, there's a lot more that goes into a mortgage than just an interest rate. If you have any questions about your specific scenario or home journey, feel free to reach out to me. Otherwise, I look forward to seeing you in the next video. Take care.